So we wanted to welcome you today to our 2026 review. We sit here today 6 months into the year, so this is a perfect moment to reflect upon what has been a very active and busy first 6 months. It's certainly been challenging from an investment perspective, and Jan Meyer, our global CIO, is going to be talking to you in more detail, answering questions we believe are relevant to our clients and the wider investor community, hopefully making clear on what's driven markets and giving you some guidance as we look ahead to the rest of the year. So yeah, where are we in H1 2026 from an investment perspective?
When we just look at the plain numbers, we would say this is a great first 6 months. To give you some indication, global stocks, MSCI World is up roughly 10% in the first 6 months as of end of June.
Yes.
S&P, US stocks, similar. Euro stocks is up 12%. Japan is up 40%.
Wow.
Yeah. Emerging markets up 24%. But this is not really...
I mean, those are some good numbers.
These are big numbers. I mean, obviously, if we annualize them, these are double them.
Yeah.
But there has been some significant volatility on the way. We had the Iran, US-Israel war in March.
Yeah.
We had...
Feels like so long ago now.
I mean, it feels like nobody cares about it anymore.
Yeah.
We had quite a significant correction in equities.
Yeah.
And by end of March, that was as if it didn't happen. And when we just take gold made an all-time high in January at roughly 5,400. We are currently trading at 4,000.
Wow.
On an intra-month basis, gold was down in March by 25%. So year to date, gold is down roughly 7%. So that's, if we just look at the plain numbers, it doesn't really tell the full story of what the first year meant for actual portfolios. Single asset class portfolios, multi-asset class portfolios. So it was quite a challenging first 6 months to navigate to see where we are currently.
So Jan, can you tell us about the H2 outlook for the remainder of the year?
H2, to be honest, I think it will continue like the first half year. My suspicion is that we probably end the year in quite positive territory with significant volatility. I think if we start with the positives, we had one significant IPO, SpaceX, which everybody had been waiting for years. It was successful. It performed after the actual IPO. It raised, like including Greenshoe, like $86 billion. We are now trading back at similar levels where it IPO'd, but still would consider it success, even though we are still in a lockup period. But we have several more sizable but also smaller IPOs to come. And that's usually, I think that would require quite sensible positive markets. So in order for them to come to the market, we would need positive support from the market.
Yeah.
And Anthropic, OpenAI maybe coming later, but this would mean in order for them to come to the market, we need stability.
I mean, it's worth stating though, I mean, these are like important events, right? They represent an important milestone from an AI perspective. Is that fair to say?
Definitely. I mean, when we just look at what stage companies come to the market now versus in the .com times, companies wouldn't stay private that long. They were maybe private for 2 or 3 years. They would IPO, and the majority of the actual value creation had or would have happened when they were publicly listed. These companies are now in the top top 10 or even top 5 companies of the globally listed companies in terms of market cap. So these are big events, and this is positive and negative. This is positive that they come to market, that they can broaden out their investor base. Everybody can participate in the theme.
Yeah.
At the same time, it means also from a liquidity perspective, they are being added to indices. And when we look at certain research pieces, big IPOs or times when there were big listings has over time deprived the rest of the market of liquidity, especially when the lockup periods expired. So this is something to monitor over the next 6 to 12 months. And obviously there's lots of excitement around them, and sentiment is key to watch as well.
Yeah.
Sentiment has changed almost binary sometimes on a monthly basis, and we see this in the hedging that has happened, and then markets rallied again 10-20% on specific sectors, doubled, tripled, or fourfold, or even tenfold certain stocks when we look at semiconductors over the last 6 to 12 months. So there's definitely some euphoria, which is to a good chunk backed up based on current earnings.
Yeah.
But there's also quite optimistic projected earnings forecasts that may not materialize to the extent that investors currently price those stocks or sectors.
Do we more generally, this is going beyond sort of the scope of sort of outlook reflections upon this year, do we feel the industry is serving clients well from an investment point of view?
I think there's probably no clear answer to that. It really depends always on the individual investment objectives, investment restrictions that individuals would put on themselves, and it also depends potentially on the size of the assets to invest. But I think what we have seen over the last 10-15 years with online wealth managers coming to the market, I mean, everything is accessible. In the past, private credit, private equity, venture capital would not have been accessible for normal retail investors.
That's true.
Even high net worth investors. When we look at investors with an investable asset base somewhere between 250,000 to a few millions, it would have been challenging to access those strategies, private equity at all, or not even thinking about good managers. And I think that has definitely changed. I think the problem is there's potentially now too much access, and like anything, when it becomes accessible for retail investors, there's potentially a reason behind it, as we have seen when we just use private equity as an example. And I think, I don't want to generalize it, but there have been lagging exits over the last 5 to 10 years, and portfolio companies may not have been performed to the extent that the managers and the investors would have wished for.
Yeah.
And there's a risk that this risk may be offloaded to less sophisticated investors.
You've seen the growth here, like buyout, secondary, all of these things are now coming in, right?
Exactly. And at the same time, secondary private equity is a very interesting topic. And if one gets access to those kind of investment, that's definitely a good thing. So to access options are there. What we have seen, and I think what's quite important, is that the traditional playbook of what the perception is on asset classes in terms of equities, bonds in general having negative correlations, that over the last 5 years that's not the case anymore. Just holding like an MSCI World equity index and a 10-year bond index maybe the right thing if we just think over the next 10, 20, 30 years and not look at it. But it may not be the right thing if you want to judge a portfolio over 1, 2, 3, or 5 years.
That needs more active management.
And that needs more active management. And what is still not accessible to anybody and always requires the individual diligence and advice is well structuring. And maybe for some individuals fairly easy, but now with
changing, we've spoken about that, the opportunity, tax landscape.
Yeah. I would say in the past, only the super ultra net worth individuals were mobile, but now we see work mobility and general mobility very easy for normal employees.
Yeah.
And even for those, it's going to be quite crucial to have a proper understanding of that and get advice, and that may override certain investment options.
Okay, so are things as bad as some people, I guess, say or comment upon around Europe?
I think
versus the US and kind of on a global basis.
No, it's a very good question. Me being from Germany, it's probably the right person to ask.
Or not.
But it obviously depends on if we really listen to the really doomsday scenarios, but there's always a gray area. Is Europe lost? No. Has Europe done certain mistakes? Definitely yes. Did they need a wake-up call? It's also a clear yes. Did it have to be in the way like Donald Trump did? Probably not. But will it lead to the outcome that should have come?
Or is good for Europe?
Is good for Europe? It will. And maybe it was needed, even though it potentially created some damage when it comes to friction in terms of relationship at NATO. But at the same time, it was required. And even today, after this going on now for 2 or 3 years, it's clear that Europe needed this wake-up call. And this is like Europe in aggregate. This is not just continental Europe. This is also UK. Europe was way too reliant on the US, way too reliant on just accepting that China is a great exporting country for traditional industries. Europe was quite smug about continental Europe, about Brexit.
Yeah.
But at the same time, did not really learn from potential valid reasons why people didn't like the European Union, even though it's a great club. But every club has its advantages and disadvantages. But what we see now, actually, only over the last few months, is what we see with investing in their own defense industries, even though it's very momentum-driven through Ukraine and Russia war.
And then the markets have reacted to that in a strong way, right? I mean, defense has really been re-rated in Europe. That's been a great investment opportunity.
Yeah, and really taking their destiny in their own hands. It will still may take years, but
10, 20 years.
We see this with startups like Helsing, who really make sure that they focus on Europe and the ownership stays to a good chunk in Europe. We see this with now implementing in Germany reforms that were needed.
Like?
Reviewing the social welfare system, making the countries more competitive. I mean, an issue that is still there, the big global tech companies, when you just use the tech sector as an example, it's really dominated by the US and Asia. And in Europe, it's really just 5 to 10 companies that are well known, and even they are long-standing ones. So, and you can see this even with the pressure that the US is putting on Europe when Europe tries to introduce regulation when it comes to these. And there's no big European tech company that could counterbalance that or could be seen as driving European innovation, even though Berlin, Zurich, Paris, Amsterdam,
London.
Very successful startups come from their unicorns, but they potentially may end up, for the most part, and in international or US hands in the end once they go to a certain stage, because they can't just grow and keep their competitive edge in a very regulated environment. And US may be too unregulated, as we have seen sometimes with Tesla trying their autonomous driving and there were accidents. I mean, it's just use it as an example, but it's just Europe needs to gain back its entrepreneurial spirit.
That's a critique of Tesla, by the way, because
but Europe needs to gain back its entrepreneurial spirit that makes it part of their mentality, and I think that's
and the scale up, right?
Scale up,
yeah, that's interesting. A lot of things we've spoken a lot around mobility of capital from a tax perspective, from a lifestyle perspective, but, also certain jurisdictions in the world now, really building infrastructure, lifestyle, financial centers which attract capital. Top of that list is the UAE, and that's despite, everything going on now, which has, in some ways undermined, some of the safety aspects of the region. But it feels like, we're seeing it in our business. What are your thoughts on the UAE today and going forward?
I mean, UAE has gone through everybody knows it now. It's now not a secret anymore. Through a massive transformation. Probably even 10, 15, 20 years ago, you had to pay people to get there. Yeah, it was almost like you really had to incentivize them in order to go along there or even take your family there for work. And then they invested a lot of money. They took a long view and attracted people by now.
Yeah.
So, and that started 5-10 years ago, and then COVID hit, and it really became the place to be in the world almost. Yeah. And that was not just an attraction from a financial perspective of no tax when it comes on the personal side, very low corporate tax, but they created pretty much a very attractive ecosystem, making it attractive for entrepreneurs, investing in international schools, entertainment, all the restaurants that you would know from the big cities in the world. Everything is there. You would come there and you would not think anymore as you just move into a desert. So it has become really almost a place to be. Obviously then the Iran war hit, and from an economic perspective, it probably has not really fed through. But at the same time, to take a positive consequence of the war is that it actually, to a certain extent, washed out the companies and potentially people who were just there for the short run or
took out the cream,
did not really appreciate. But at the same time also, and similar to Europe, it just happened in a way quicker way. The Middle East has always been quite dependent on the US in terms of security, partially in terms of financial flows, capital.
Yeah.
And we have seen this since then. I mean, the momentum there in order to strike new alliances. I mean, we see this. Who would have thought that certain countries who were completely opposed to Israel would now almost team up? You see local investments in defense also going up. And And what we see is like, yes, people have been coming back, and yes, everybody, regardless where there's a war, everybody wants to go into a safe place. But many people have returned, and many people actually have not left. Yeah? And new alliances have been struck in a very, very short time. And so it's to a certain extent what, from a financial perspective, what Switzerland has been like 20, 25 years ago. And they have morphed into this new ecosystem that's attractive to be there.
Yeah, very interesting. Kind of brings us on to another point, which is technology, new sectors being created, throwing capital, on a blank piece of paper and getting the right players in. We haven't spoken about this, but crypto and the rise of digital assets, even tokenization, all of this is happening. And, Switzerland actually taken a very interesting role within Europe again versus, perhaps other financial centers, but certainly in the UAE, again, that's happened. Just your comments on the whole digitalization of financial assets?
I think we have to separate, as you say, between digitalization of financial assets or assets in itself versus just having Bitcoin or other cryptocurrencies as a store of wealth or as a payment. And we have seen, just to touch on that first, we have seen obviously when Trump came in, like Bitcoin made an all-time high. Now we are trading more than 50% below that. So from that perspective, I think this still has to be proven. Also, we've seen this when the geopolitical events, at least in March or even after, gold has corrected, but Bitcoin has not delivered on its gold promise either. So we have to see where that goes. But from a technology perspective, I think that's the place to be, and that's where potentially the biggest value add will come in terms of payment systems, which is dominated by Visa and
the
traditional ones, and we are seeing this in many ways in terms of digitalization of assets, art, property, and this is where the biggest benefit, at least at this point in time, is potentially be there.
So Jan, I wanted to thank you for that. It's been very informative and interesting to hear, I think, what are quite clear views for what's happened and also your outlook for the rest of the year. So thank you. I think it's also worth stating to people listening to this for the first time, because it's something we're trying to do. They should not hesitate to reach out to you and the investment team if there are questions. We want to maintain that open dialogue. Anything from your side to close off?
It was a pleasure. Thank you. And hope to keep the conversation going on.
Thank you,